Get Rich Slow with John Wolf. Hey, today I'm going to teach you about the basics of what's going on in a conventional loan. And there's very little more important for you in understanding your wealth and how it affects you than understanding the deal you're making. So I'm just going to give you the briefest introduction of that. I have other videos that go deep into the math that show you how to actually compare written offers. And please reach out and take a look at those as well. But first, smash that like button. Please subscribe to my channel. Share it if you think this is good information, and have an awesome day. So here's my license information if you want to get a hold of me. I do home loans in Oregon and Washington. Here's what's going on with conventional loans. So therefore, generally people with a better credit score who have a little bit more money down and don't have recent BKs, recent foreclosures. Now, you have to at least have a 620 credit score, but the interest rate is a lot higher, and the mortgage insurance, if you're not putting 20% down, is a lot higher with a lower credit score than with a higher credit score. And you might not even get an approval. There's sort of a formula of risk that they go into. But here are the factors that people don't think about or they don't understand correctly. So a lot of people fixate on interest rate, and that's not really the only thing you should be looking for. In fact, it's not even probably the main thing you should be looking for. So let me break down the places that your money goes, which is variable, which you need to look at when you're getting a home loan, especially a conventional. So take a look at the interest rate, then take a look at how many points or how big of a lender credit you're getting. Then take a look at your mortgage insurance rate if you're not putting 20% down. And you need to compare all three of those between different lenders, and you might want to even compare different down payment amounts. Why do I say different down payment amounts and not just the highest you can do? Well, in a lot of scenarios, it actually makes more financial sense to put 5% down instead of 10, 15, believe it or not, 20 or 25% down. There are actually better things you can do with your money. And if your credit score is high and you work with a mortgage company, which the company has a low mortgage insurance rate, then your money might be much, much, much better applied to something other than putting 25% down on the home loan. It might make way more sense to put 5 down. Now, when you look at a payment breakdown, let me tell you what's going to be on that. So you're going to have the principal, that's the amount that's going to actually pay down the loan. You're going to have the monthly interest, which is dependent on the interest rate and the loan amount, just like the principal. And you're also going to have your taxes rolled in. You're going to have your homeowner's insurance or hazard insurance rolled in, and you're going to have your mortgage insurance rolled in if you're not putting 20% down or more. Now, past that, you need to look when you're getting your closing disclosure or you're getting your loan estimate. What are the fees? How many points are you being charged? So 1 point is 1% of the entire loan amount as a fee up front. You don't ever get that money back. So I am never really in favor of my clients paying a fee unless it's just like a rounding error. And I have a video about why you would choose a particular interest rate and point structure. So I hope you take a look at that one as well. Finally, there's the mortgage insurance. And the mortgage insurance does, by the way, vary wildly by your credit score, by the amount you put down, and by what loan company you're going with. So definitely shop that around. Very frequently, I do quotes, competitive quotes, and I have a similar or a lower interest, but the my fees are maybe a couple dollars higher, but I'm not charging points and they are, so it's less to close. But we take a look at the mortgage insurance and I'm like $100 a month less. So that's a really easy decision. If I'm $6 more on the interest and I'm $100 less on the mortgage insurance, well, you combine that, I'm still winning by like $95 a month or more. And that's the kind of stuff that's important. Some things that are also important for some people, especially if you're planning on doing the get rich slow lifestyle and you might have to do more refinances than most people would want to do or would make sense for some people. Working with a mortgage insurance or mortgage company like Caliber, who actually holds your loans in principal, and we can do what's called a recast. So if you have extra money and you want to put it down for just a $200 flat fee, we'll recalculate a lower payment for you. Or if you want to do a refinance, we have some pretty giant incentives, and we have the ability to roll the escrow account forward, which most banks just can't even do because they're just trying to pay off a mortgage and then write a new mortgage for you, where we're paying off our own mortgage and rolling it forward. And that's actually one of the reasons that my company has been able to smash it during this really strange and difficult financial times for a lot of mortgage companies. So anyways, those are the key factors you need to look for. And definitely, if you have any questions, put in that comments section. I will get back to you. Again, share if you think this is interesting, and have an awesome day. Bye.